Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is time here on The Answer to talk about money. You know, big news this week as new tariffs were announced. We're going to talk about that as we go on. I have a great guest today. He's going to give you a look into the future. This is new technology. This is something that is in the news now, but it's going to be even more in the news. So you want to hear what he has to say. And I want to talk about some of the financial things that are going on with computers and electronic trading. We'll get to all that. We've got a lot to cover today. And I want to start by saying, you know, there are people who believed that everything Obama did was wrong. And there are those that believe that everything that Trump does is right. And at the same time, you have people that believe that everything that Obama did was right and everything that Trump did is wrong. That's the world we kind of live in. But I want to say I believe that Obama did some things right and some things wrong. I believe that Trump has done some things right and some things wrong. And what I really want to look at is not specifically the person or the administration, but what the numbers really say, what we're doing, where things are going, what the economy is doing, what industries are doing. That's the focus. And administrations can have some impact on what's happening, some impact on different industries, but in total, they don't have as much impact as a lot of people give them credit for. You know, this is the week that the tariffs were announced, and I think it's really worth looking at that. And I want to say the way I look at that is I'm not in favor of the tariffs. I'll be upfront in saying that. I believe, however, that you prepare for the worst and hope for the best. And I hope that it all works out as they think it will. At the end of 2010, my clients had reached a new high. We'd been through the big dip of 2007, 8, and 9, and the economy was headed up. I didn't see any clouds on the horizon as we went into 2011. When I made my end of the year evaluation of 2010, when I made my forecast and my predictions for 2011, I said, I don't really see much on the horizon. I don't see clouds that are going to slow down the economy. You know, predictions are predictions. You don't see all the things that are going to happen. And of course, on March 11th, 2011, on that year in which I didn't see any clouds happening, I didn't see any drawbacks. Of course, on March 11th, 2011, the tsunami hit Japan and Fukushima melted down. And suddenly it threw the economy into a topsy-turvy. This year, I started by saying I was very optimistic. They passed a tax bill, and I felt that tax bill was going to be very, very positive for companies, somewhat less for individuals. And for those at the low end, I thought it was going to have a negative impact in the long term. And I didn't see any real clouds. I raised the question, however, of what might be a black elephant. People talk about black swans, but the elephant in the middle of the room that people are walking around, they can see that there's a problem that could be there, but nobody really wants to deal with it. A black elephant. And I said, we're looking at a black elephant. Should we get into a trade war? What happened this week could be the beginning of a trade war. With Gary Cohn gone, he was the biggest voice within the Trump administration for free trade, and we're left with Peter Navarro, an economist, who is a protectionist. He wrote a book, Death by China. He's definitely feels that China has an obvious, incredible threat to America and the American economy, but he's considered to be on the fringe of economic theory. He's an outlier. That may not be bad to always be an outlier. I'm considered an outlier. What I do is very different from almost all financial advisors. So I can't say that being an outlier is completely wrong, because I am one. But I can say it requires additional evaluation. It requires real numbers to see if it's going to be true. And we're going to be in this process this year of probably expecting the worst and hoping for the best. Now, there were two contributing actions that happened today. Happened this week. President Trump announced 25% tariff on steel and 10% tariff on aluminum. And he said he'll make some exceptions for Canada and Mexico and maybe some other countries, but Canada and Mexico if they sign NAFTA. So he put NAFTA on the table along with the tariffs. And I think both of those have to be considered almost one. I got my master's degree, my MBA from Carnegie Mellon in Pittsburgh. In Pittsburgh, if you know Pittsburgh, it's located at three rivers, the Monongahela, the Allegheny, come together and form the Ohio River. And I tell the story fairly often, so you've heard it maybe before. But if you look, there's a small mountain, Mount Washington. It's like Somerset Hill in Bellevue. It's called a mountain, but it's barely a hill. But up at the top of that, when I was single at the time, I was getting my MBA, used to take my dates up the tram to a restaurant up there and look back down, because it's one of the greatest sights I've ever seen. You had the smokestacks coming from J&L Steel, belching flames into the air, probably 100 feet. And the flames changed color. It was a sight to see. And at that time, the U.S. dominated the steel market. It just completely dominated the world steel market. We had the market share. You know, today J&L Steel's gone. Steel, at that time in Pittsburgh, had reached a peak. Steel, at the beginning of the 1900s, had created a new class of wealth. From 1875 to 1920, steel production ran up from 380,000 tons to 60 million tons. That was the growth of steel in the early part of the 20th century. By 1900, we were the largest steel producer in the world. We were the lowest cost. We were supplying it to most of the world. And from 1890 to 1900, just in those 10 years, steel output doubled. And when you look at where we were by the time we reached the 70s, you had steel companies that were a large part of the Dow, U.S. Steel, Bethlehem Steel, Allegheny, Inland, J&L. You can go down the list. Huge steel companies. We were supplying the world with steel for the most part. And we'd created a lot of wealth for a lot of individuals because of that. But those steel companies, as they grew, they were making small innovations. But as we rebuilt from World War II, where much of the world's steelmaking capacity had been destroyed, foreign companies began to make significant changes. They were doing continuous casting. They were doing other innovations. And even in the U.S., there were companies that were beginning to do mini mills that produced low-cost steel. By the 1990s, the steel industry in America was dying. It was on its back. Instead of real innovation, however, the steel companies went to Washington and asked for protection. They said these companies from offshore were being supported by their governments, which they had been. There had been this rebuilding. The governments had helped support the rebuilding. And these companies were being supported by the government. So the steel industry, the steel workers, everybody went to Washington to get tariffs put on steel. And instead of real innovation, what happened is the steel industry slowly began to die. So much so that the innovation that should have taken place didn't take place. And those companies that I mentioned Bethlehem, Inland, Allegheny, J&L, those companies would eventually mostly be dead. By 2002, they were again pressed. They were on their back. There were bankruptcies about to happen. They went through the Bush administration, and Bush imposed tariffs for the same reason given by President Trump. The same exact reasons. It was the power of the steel industry. 30,000 steel workers were bused to Washington, D.C. Remember that? If you saw that with all those steel workers in Washington, D.C.? So Bush filed a complaint, actually before 2012, with the WTO and won a judgment. So the tariffs came on steel, but it didn't make a huge difference. In 2002, there were 169,000 jobs in steel industry, and since then, 32,000 jobs have been lost. Production has increased. Productivity increased. Actually, there have been some significant innovations. The mini mills have grown up and become a significant part of steel production. But the steel industry, which in the 90s was already on its back, is still on its back. We're going to come back and talk about the tariffs and the impact of the tariffs right after the commercial break, so don't go away. There's a lot more to cover. I've got a great guest today. We're going to also talk about some of the computer impacts on stock and bond trading. We've got a lot to cover today, and we're not done yet with the tariffs. This is just the background. We got a lot to cover. Don't go away. We'll be right back after the break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the tariffs, talking about NAFTA. We've got a lot to cover, and I've got a great guest. We've got more to cover at the end, talking about what's going on with computerized trading. But talking about the tariffs and talking about the steel industry. Not enough time to talk about aluminum, which is where I started my career. We'll talk just about steel. In the U.S., if you look at where we are, the number of jobs has decreased from 169,000 in 2002 to 137,000. And yet, production has gone from 971 million metric tons to 1.63 million metric ton. So essentially, for every man hour, you've seen production grow twofold. We've made some significant progress. The real issue has been in China. No question about it. I've talked about it before. I talked about China, its growth. I talked about their focus on building. Under Mao, with his Great Leap Forward in 1958, his plan was to make more steel than Britain. But as China grew, as China has come through these years, they began to commit with a government that could support the industries. They began to build major industries. One of the industries they built, and one of their focuses, was steel. And they overbuilt. They had the money to do it because it's not a market economy. They were able to pump in money. And by 2 years ago, there was an excess capacity of 600,000 metric tons of steel being produced. And most of that, more than that, was being shipped out of China to various places. It was one of the causes of Brexit. People in Britain saw that a couple steel mills were being shut down because of the excess steel capacity. So there's no question. There's an issue of steel overcapacity. Normally, when that happens, a country is able to go to the WTO and declaring that there's a problem with steel prices. And by the WTO, you get a judgment, and you're able to do what Bush did, declare tariffs and not have a reaction from other countries. But that's not what this administration did. They simply said it was by national security, and they were going to impose tariffs. That's upset our allies and the rest of the world. The EU has already announced that they're going to retaliate. They're going to put tariffs on $3.5 billion worth of brand name goods in the U.S. Think about it. They're going to put a tariff on bourbon. Bourbon from the state of Kentucky, very much targeted toward Mitch McConnell. They're going to put a tariff on Harley Davidson, very much Wisconsin and Paul Ryan's. They will begin to put tariffs on products of politicians. They're specific and they're designed to go after and retaliate for what we're doing. It's a tit for tat kind of thing. And that begins to happen. And when that begins to happen, then countries begin to retaliate again. Already, the president has said, if they do that, then we're going to tax German cars. You know, it becomes a tit for tat, tit for tat, tit for tat, one after another. Canada and Mexico have complained, and they're already studying what to do with their tariffs. We know that China's thinking of something. We know that Canada and Mexico are signing an agreement, which essentially is the Trans-Pacific Partnership, which we backed out of. We know that those things are going on. And at the same time, we have the negotiations going on for NAFTA. There's a question about how those negotiations are ever going to get done. We've reached almost an impasse. There's a few things that have been resolved. The people that are negotiating have been positive. But when you look at the U.S. demands, those have crossed red lines, which it's doubtful that either Canada or Mexico will step up to. Our demands were to phase out, in Canada's case, the dairy and poultry and egg subsidies. You know, that's a very political thing. Think about the power that the steelworkers have had in terms of getting the tariffs passed time and time again. Here's that industry. And when negotiations were beginning on NAFTA in the beginning, Canada got up and walked out of the negotiations over those regulations, the dairy, poultry, and eggs. That was a walkout. It happened in 1987. But the real demand, the real question, there's two things that are really upsetting Canada and Mexico, in which they said they can't find a resolution to. Right now, 62.5% of auto parts originate within NAFTA. President Trump wants 85%. And in addition to that, 50% of those coming from the U.S. What that really means is if that's imposed, car manufacturers would simply bypass the deal. They would pay a 2.5% duty to import cars from Mexico or Canada into the U.S., and they'd raise prices to consumers. They would source from other places than America a supply. Instead of having American products going across the border to Mexico or going into Canada and coming back again, they would source those products from China, from Australia, from Brazil, instead of from the U.S. That's the first thing that's really hung up the negotiations. They're not going to get cars that are shipped into the U.S. that have 50% of materials from the U.S. The second thing is a 5-year sunset clause. So every 5 years, the NAFTA would expire and it would have to be renegotiated. The issue with that is when people are investing in a country, are you looking at a 5% time period? You're looking oftentimes when you're building a factory at 15 or 20 years. If you're saying it sunsets after 5 years, you could build a factory and have the whole thing blow up in fewer than 5 years. It's going to chill cross-border investment and trade. You know, since 1994, when NAFTA was passed, Mexico and Canada have become the second and third largest exporters to the U.S. after China. They're the leading importers of American products. That means we're shipping more products into Mexico and Canada than any other countries. You know, if we lose NAFTA, you can look at tariffs being put on agricultural products. They're already talking about wheat at 15%, 25% for beef, 75% for chicken and potatoes. Clothing and handbags and other things, 15 to 20%. Argentina is already negotiating to replace the U.S. in supplying agricultural products to Mexico. And China is already negotiating with those countries to supply a lot of products that the U.S. already supplies. You know, if we lose NAFTA for Mexico, it means essentially the loss of 1 million low-skilled jobs. For Canada, 125,000. For the U.S., at least 250,000 jobs that will be lost. You know, NAFTA is not a zero-sum game where if one country gains jobs, another country loses jobs. What we see is both, or not both, we've seen all three countries take advantage of NAFTA and have growth. And the stakes are higher. Right now, by tying the tariffs to NAFTA, it's raised the stakes to a much higher level. You know, whether Trump is the real art of the deal or not, it's very different from negotiating a real estate purchase. If you don't buy a building, you just move down the street and buy another building. When you're negotiating a trade agreement with a country or with two countries, you don't have the ability to say, well, we don't like what you're doing, so we'll get the same things from somewhere else. It doesn't work that way. You know, we're not going to find another Mexico. We're not going to find another China. We have to work with each one. We're not going to find another European Union. We have to work with them. We're not going to find another China. We have to work with them. You know, it's very ominous and concerning. I have great concerns about it. You know, for my client portfolios, I started changing at the beginning of last year, slight changes, making sure that if we had a trade war, we would survive that. That was where I focused on client portfolios. It's prepare for the worst and hope for the best. I hope that this doesn't result in a trade war. There's no winners in a trade war. On that, I strongly disagree with Trump. There will be no winners in a trade war. There are only losers, and there's losers on all sides. A trade agreement is a win-win for the countries that do it. No agreement is a lose-lose-lose situation. But maybe I'm wrong. I hope I'm wrong. I hope that everything goes very, very well. But in the event it doesn't, I just want to be prepared. That wraps it up. That's what I advise my listeners as well. I want to introduce Nathan Kundtz of Kymeta. We're coming to a break very soon, but welcome to the program, Nathan.
Thank you. It's a pleasure to be here.
So we're going to come and start with your background right after the commercial break. So don't go away. You want to hear what Nathan has to say. He's going to give you some looks into the future and technology. Fascinating story you've got to hear. It's coming up right after the break. If you missed this program, you can find it on YouTube. You'll find a podcast on our website. It usually takes us about a week to get that done. So look for it there. If you missed any part of this, if you missed any of the other programs, be sure and check them. We did a series on what's wrong with financial planning. That's now on the website. So check it all out. We'll be right back after the commercial break with a tremendous insight into the future.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
I'm here with Nathan. I'm going to let him tell you his last name because, as I often do, I mispronounce last names. So it's Nathan of Kymeta. Nathan, tell us your last name.
Thanks, Mike. It's a pleasure to be here. My name is Nathan Kundtz.
Okay. So let's start with your background. Tell us your background.
Sure, Mike. So my professional background, I think, really starts at Duke University, where I did my master's in electrical engineering, PhD physics. And the PhD work that I did was in a field called metamaterials, where we were taking a look at some new electromagnetic phenomena and the ways in which we could design all sorts of devices around waves, but in particular light, in new ways. And that research caught the attention of a company out here called Intellectual Ventures, you may be familiar with.
Yes.
And so Nathan Miravold and his team came out, and we did a lot of work with them at Duke, and they invested in the intellectual property that we had generated and some of the IP coming out of other universities doing similar work. And they were really on the leading edge of that and looking for commercial opportunities to build product based on those tools. So as I continued my PhD work, I really took it in that direction. And you may have heard about some of the things that we developed, negative index materials, where light appears to travel backwards, cloaking, where we actually bend light around a central location. And both of those were really interesting, but at the end of the day, they were science projects. And I became very keen to find ways in which we could use the tool sets that had allowed us to do such amazing things and apply them to commercial purposes. So I partnered with Intellectual Ventures, and they eventually asked me to come out here to Seattle and help them find ways to do just that. As part of that process, we started thinking about metamaterials in a different way. So the devices that we had been building really were treated sort of like lenses. You can think about wanting to design a better lens, like for eyeglasses and how light shines through eyeglasses. And instead, we started to we treated them like surfaces. And instead of bending through a physical medium, we bent light using diffraction. And if you can remember back to sort of taking high school physics and shining a laser through a diffraction grating, we started to build devices that would do something similar and allow us to do what we wanted to from a flat surface and reconstruct that light as we needed to. The application that we targeted right away was satellite communications. I think we saw the dish, which is ubiquitous in satellite communications, and felt a strong urge to get rid of that. And for good reason. Satellite communications has just some amazing properties. You have ubiquity of coverage. You have a massive amount of spectrum, almost 5,000 times more spectrum and potential capacity than you have with terrestrial connections like to your cell phone. They're resilient to natural disasters. They're the last line of defense when the military goes in or when a hurricane hits. And you have some amazing security properties as well. Challenge is you're always pointed towards a dish, and that means you can only use it for fixed services. So this wealth of wireless capacity gets stuck servicing fixed locations, and we wanted to bring that into mobility. So I started incubating the effort at Intellectual Ventures, and we just showed some of the earliest devices there. Actually, the very first working samples that we produced, I built in the bathroom at Intellectual Ventures with a small team. It was a lot of fun. We had about a 4 foot by 4 foot bathroom where I actually built up a clean room. They didn't have one, and we needed a space, so that's where we did it. Yeah, you put a chemical hood over the toilet. You put the bench and a mercury eyeline lamp, and built up a little mask aligner. It was fun.
Not a garage. It
was not a garage. Yeah, I hear about people who tell me the wonderful stories about how they built companies in a garage. So if only I had a garage. If only I had had a garage, I would not have had quite so many chemicals enter into my system by building a clean room in a very small bathroom. But anyway, we were successful in producing some of those early prototypes, and by virtue really of the environment that existed around Intellectual Ventures, we had a lot of people who could see that and understand the vision, and most notably probably Bill Gates, who is participating in a lot of the global good work that had been happening at Intellectual Ventures. And I had the opportunity to do what I think every engineer loves to do, which is explain to someone who cares passionately about what you're doing how you plan to change the world, tell them what you're going to do next at each step, and then do it and come back and show that you did it. We did that a few times at Intellectual Ventures and with Bill, and after a couple of years, it became clear that we were on track to spin off a company and that we'd be able to productize the technology. As we did that, Bill became one of our biggest supporters. I went with the company. I did not stay at Intellectual Ventures, so I went with the company and was the Chief Technology Officer of Kymeta as we started up. And then about 2 years in, we went through a management change, and I was asked to step into the CEO role. And so began augmenting my skill sets, and I remain in that position today.
So when you talk about the technology, and I think it's important to understand, you talked about satellite technology, and I think about the cell phone. Cell phone, you have towers located around, but every so often you run into a space where there's a dead space and you have no communication. With a satellite, I would assume that what you're getting is 100% coverage.
Yeah, that's exactly right. So the reason that you run into dead zones with cell towers, I mean, there's a lot of reasons, and there's a lot of things that impact what's called signal propagation. But fundamentally, they're close to the Earth, and so as you get further and further away from the cell tower, more and more things can block that signal. So trees, mountains sometimes, but eventually the signal decays and it's not strong enough to reach your phone. In the world of satellite communications, that satellite is actually 22,000 miles away from the surface of the Earth, and it's orbiting the Earth in typically what's called geosynchronous orbits. It means it goes around the Earth at the same rate that the Earth turns, and because it's orbiting at the same rate that the Earth turns, it doesn't appear to move in the sky. Because it's so high up, there's really nothing to block it. Once you have a line of sight, you're in free space all the way to the satellite. And what that means is that you cover huge amounts of territory. And so there's hundreds of satellites in geosynchronous orbit today, but you really only need, in terms of coverage, you only need about 3 to cover the entire Earth with capacity. We add additional satellites because you can add in more and more capacity by doing so. But the coverage is one of the paramount things. And so when you look at the communication systems of the future, always-on connectivity is becoming more and more crucial. And that's, I think, where we'll talk about automotive, for example. That's a great example of a world where right now, if you have connectivity, sometimes, the downside is that you might lose your YouTube video. Well, in the future, that becomes more and more critical, and those are both life and business critical systems. And so meshing of cellular connectivity where you have it and satellite connectivity where you don't becomes an important platform for solving a lot of those problems.
So, I mentioned before when we were off the air, we talked a little bit. I have a Tesla, and the Tesla gets an electronic signal all the time. It downloads new software and so on. But that's not satellite driven.
That's right. That's not satellite driven. So the Tesla uses a couple different means to get updates. Most of the updates that it's getting are actually happening through your home Wi-Fi. And so you'll sign the car into your Wi-Fi. And for the people in, let's say, the income tax bracket that buy Teslas, that's usually fine. They've got an attached car garage. And it's been really interesting to see what Tesla has done in the automotive industry, because that example of how they can really delight their customers on a regular basis has created a demand signal across the entire automotive industry. And now there's clear expectation that will happen in all vehicles.
And as we talk about, right now the news is about self-driving vehicles, automated vehicles that take you from place to place. I would imagine that will require satellite communication.
I think satellite's going to be a really important part of that entire platform, and for 2 reasons. And the one is you highlighted, is the always available connectivity. It's just not acceptable to be somehow in a national park and not be able to access the critical systems of the car.
Or to be driving down the freeway at 70 miles an hour and suddenly you lose your connection in
Yeah.
this car. And you're watching a movie while you're driving and suddenly your car is...
It's funny. We, I think at least once a week I'm on the phone with somebody and the signal drops and I say, this technology, everybody thinks it works. It doesn't really work. But the other thing about satellite is you can do amazing things with broadcast. I think we're all familiar with DirecTV. In that case, you're actually putting 6 gigabit per second into every home on the planet, in America. And that level of connectivity is possible via satellite because you're hitting hundreds of millions of people with the same signal. And the efficiencies that can be achieved with that are really tremendous. Ultimately, when we talk about wanting to position hundreds of gigabytes or terabytes a month into every vehicle in a country or around the planet, as far as I know, satellite's the only way that you can efficiently get that amount of data into that many platforms.
And that's just one example of what Kymeta can do.
That's right.
You have so many things and so many possibilities. You know, the idea of this program is to give people a view into the future, and I think you've just done that. It's amazing as we talk about the application of things. You know, I have a TV. I can control the remote. I don't have to understand what goes into the TV and how it's broadcast.
Mm-hmm.
You know, that's all part of the technology. And I think what you're enabling is the future of where we're headed.
Thanks. We like to talk about making connectivity as easy as a view of the sky. I think in the future people will associate being able to see the sky with having a really robust broadband connection.
That's great. Great technology, great story, great insight into where we're going. Thanks for being on the program.
My pleasure.
We're coming to a commercial break. Don't go away. I want to talk about computerized trading to some extent and what's gone on, because things have really changed since 1986 when I've been in the industry. Don't go away. We've got a lot to cover, and I'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, welcome back. We're talking about money. We're talking about high-frequency traders. We're talking about lots of things that have happened. When I got into the industry in 1986, there were three exchanges. You had actually there's more, but three main exchanges. You had the New York Stock Exchange, you had the American Stock Exchange, you had over-the-counter, and you had some small exchanges in San Francisco, Philadelphia, Chicago. Most people understood where stocks are traded. But what's happened is today there's 19 different exchanges, and I don't think most people understand what goes on with trading today. You know, you have in New York City, for example, you have the New York Stock Exchange, and stocks are traded on the New York Stock Exchange. They're bought and sold. That's one market that's made. But in Chicago, you have the options trading. And the option, people can buy an option to buy a stock at a given price at a given time. And every once in a while, you get a difference. Suddenly you'll get a stock where some people are piling into it and they'll drive the price up, and it takes a little time for the option to catch up with that, or vice versa, so the stock goes down. Or you'll get people buying the options, and so you have a discrepancy. You have an arbitrage that can be taken. Now, to understand how all that plays out with computerized trading, also have to understand what's gone on with data transmission. In the early 1900s through 1980s, we transmitted data over copper wires. You just listen to Kymeta, and they're transmitting things using light through the atmosphere. But in the early 1900s to 1980s, we transmitted analog data over copper wires. And in the 1980s, we began to make changes by installing fiber optic cable, where we were transmitting light data, digital data. It's faster and it's smaller. Several years ago, I was at the Communications Museum, which has now been shut down, sad they say. But they had an example of a copper wire cable and a fiber optics cable. And you could fit 864 fiber cables in the same space as one copper cable. I mean, it's really amazing. And transmit far more data on one fiber cable than one copper wire. So you're multiplying by 864, and today it's probably even greater, 1,000 times the amount of data on one fiber cable, and it's so much smaller. So as we installed in this U.S., as we installed fiber optics cable, it was installed with right-of-ways. a lot of fiber cable runs along railroad tracks because the railroad tracks are there. They go from one point to another. Going from Chicago to New York, you have rail lines. You can install a fiber optics cable in talking to the rail company. Install it. But, the railroads, they twist and turn. So somebody came up with the idea in 2010. A group was formed to take advantage of the fact that normal fiber optics cables ran not straight, but they had all these turns. If you could make a straight line between Chicago and New York and transmit that data through a fiber optics cable, you could cut off 4 milliseconds. Now, a millisecond is 1/1000th of a second. All you needed to do by gaining 4 milliseconds between Chicago and New York is install a straight line. And they raised $200 million initially, somewhere between $200 and $300 million was put in the ground to put in a straight line fiber optics cable, Chicago to New York. Cost them somewhat less than $300 million, somewhat more than $200 million. But once that was installed, they were charging between $20 and $30 million per year for people to lease that line. $20 to $30 million for people to lease that line so that they got that information 4 milliseconds difference. So they could arbitrage that. So they could buy in Chicago and sell in New York, or sell in New York, buy in Chicago. They could buy in New York, 4 milliseconds. So you could be 4 milliseconds before that information got to other people to buy and sell. That was completed. That made a significant difference. And you began to develop other exchanges. To show you the value of what that's worth, there's an interesting Odyssey story. Goes for a guy, Sergei Aleninkov. 2009, he was arrested by the FBI. Interesting story because he uploaded a file from the computer at Goldman Sachs. He had been a worker at Goldman Sachs, had been hired by another company to build an algorithm to take advantage of 4 milliseconds. Goldman Sachs was already taking advantage of it. This is something that he had developed for Goldman Sachs. Now another company wanted to use his expertise to develop it, and he downloaded the file. Goldman Sachs had him arrested, and he was convicted and sent to prison for 8 years. After a year, he was released because the appeals court said he didn't commit a crime. He developed this. This was his. Goldman Sachs claimed that what he stole was worth $500 million. On that one thumb drive was worth $500 million. It was their secret sauce. It was their algorithm on how to take advantage of this 4 milliseconds, worth $500 million. It was because it was the speed of which things were done. In that time, 4 milliseconds, a computer could analyze the data in Chicago, analyze the data in New York, and make a trade before anyone else could. And that was worth that amount of money. And it not only could look at those things, but as this whole algorithm thing developed, they could read the news and make trades. Today, over half the trades are now being made by computer. No human intervention at all. It's very rapid, very fast, but it's all, in my opinion, a zero-sum game. Because if somebody makes a little bit of money, somebody has to lose a little bit of money. I'm a long-term investor. For me, I love to see this because for us, we're looking at a stock that we buy at 40 going to 60 or 90 or 100. We're not looking at a stock that we buy at 40 going to 40.05 cents. I think let the computers do their thing. I find it funny. And I find that there's times in which the computers misread the news, and that should be to our advantage. We buy things cheaper, we sell them higher. Anyway, that wraps up things today. We have 19 exchanges. We have computers that do over half the trades in the U.S. We have orders going in on February 18th, 2010, 1.2 billion orders, but only 89 million actually executed, less than 1%. That's the kind of thing we deal with today. Got to take advantage of it. I mean, I think I'm smarter than a computer. Maybe that's not true. But anyway, have a very great weekend, and I will be back next week to talk more about money, because the answer is about money.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by